Welcome to the study of insurance risk, a foundational element of the global financial system and a core subject within economic science. This presentation delves into the essential nature of risks, their classification, and the structured methodologies employed for their management and assessment in the context of insurance. Risk is the possibility of an event that can cause losses. Insurance helps protect people and businesses from financial losses due to unwanted events. In this topic, we study the concept of insurance risk, its classification, assessment, and risk management. Key points of the topic: nature, role, and place of risks in insurance, what risk is, and why it is important for insurance. Risk classification, types of risks by different criteria, insurable/non-insurable, financial/non-financial, etc. Organization of risk management, methods of assessing risks, and ways to control them to minimize losses. In economic literature, there are many attempts to give a theoretical definition of the concept of risk. Some researchers claim that risk in its essence is uncertainty, caused by the impossibility of predicting the final result, which may be expected or unexpected, but can be measured quantitatively. Every type of human activity is accompanied by risk, which is an objective phenomenon in all areas of social life. Therefore, the category of risk has exceptional importance in the activity of economic entities. With the development of civilization, trade and monetary relations appeared, and risk became an economic category. As an economic category, risk is an event that may or may not happen. When this event occurs, there are three possible economic results: negative, loss, damage, neutral, or positive, gain, profit, benefit. Since risk is a systemic concept, we can distinguish the following elements. Object of risk: a controlled system in relation to which decisions are made and whose efficiency and conditions of functioning are not known in advance. Subject of risk: a person, individual, or group who is interested in the results of managing the object of risk and has the authority to make decisions regarding it. Source of risk: factors, objects, phenomena, processes that cause uncertainty in the results of decisions. Risk is a prerequisite for the emergence of insurance relations. The risk factor and the need to cover it create the demand for insurance. In insurance, the concept of risk becomes more specific. Risk is defined as the possibility of a negative deviation between the planned and actual result. That is, the danger of an unfavorable outcome for a particular expected event. The concept of risk is closely connected with the concept of loss. Risk shows the probability of a negative deviation from the expected result, while loss represents the quantitative expression of such a deviation. Therefore, risk is realized through loss, taking on measurable and real forms. In this regard, there arises an objective need to collect, analyze, and summarize information about various unfavorable events to identify general development trends and patterns of their occurrence, and to scientifically predict risk. The term insurance risk refers to an event against which an insurance obligation is created. According to Article 8 of the Law of Ukraine on Insurance, an insurance risk is a certain event for which insurance is provided and which has signs of probability and randomness of occurrence. Thus, any specific risk is only the possibility of a certain event occurring with a defined probability. Randomness means the suddenness and unpredictability of such an event. Insurance involves both objective and subjective probability. Objective probability reflects the laws inherent in phenomena and objects as they exist in objective reality. Subjective probability reflects cases that arise when a person ignores an objective approach to reality or insufficiently considers the influence of natural and social laws. In addition, risk can also be represented through logical probability, which is based on understanding the laws of nature and society using methods of induction, deduction, analysis, synthesis, and hypothesis. Logical probability is applied when developing and introducing new types of insurance that lack or almost lack a previous information base for observation. An insurance risk is a product of human consciousness or imagination, uncertain in terms of time and frequency of occurrence, uncertain in terms of scale and causes of damage, a result of human actions or the influence of external natural or technological forces. From the policyholder's perspective, they know the nature of the risk and will seek acceptable insurance protection, with the price of the insurance service being an important determining factor. From the insurer's perspective, they receive information about the risk, decide on the scope and type of coverage, and determine the insurance premium for the coverage. Features of insurance risk: randomness, uncertainty regarding the time and size of the loss, and no connection between the insured loss and the policyholder's will or behavior. Ability to assess loss distribution, determining the planned extent of loss and its probability. Uniqueness of loss distribution, precise definition of insurance objects and loss amounts in the insurance contract. This condition is especially important for determining insurance compensation. Independence of insured loss distributions, avoiding risk concentration by the insurer when entering the insurance contract. Assessment of the maximum possible loss. Objectivity, properties and factors capable of affecting a person's future financial state for better or worse, creating certain risk circumstances. Subjectivity, the perception by human consciousness of dangerous events that can lead to risks. Risk classification means dividing risk into specific groups based on defined characteristics. Depending on the criterion, the following classification of risks can be proposed. By insurability, the willingness of a subject to take responsibility for covering losses to policyholders in the event of undesirable events. Insurable and non-insurable risks. As mentioned above, according to the law of Ukraine on insurance, an insurance risk is a certain event for which insurance is provided. It has characteristics of probability and randomness. Only those risks are insured for which it is possible to estimate the probability of the insured event, determine the amount of loss, and calculate the price of the insurance service and the possible share of insurance compensation. Non-insurable risk is an event that causes losses for the affected person, but cannot be transferred to insurance, usually due to the insurer's unwillingness or inability to assume the obligation to compensate for losses resulting from a particular event. These are risks for which it is difficult to estimate the probability of the insured event, determine the size of the loss, or calculate the insurance premium. Thus, insurable risks are risks for which the level of acceptable losses can be easily determined, and the insurance company is ready to compensate them. Property, personal liability risks. Non-insurable risks are risks that most insurers avoid because the probability of related losses is almost unpredictable. Market, political, production, personal risks. Other criteria for risk classification. By assessment criterion. Financial risks, results can be measured in monetary terms, for example, theft. Non-financial risks, results are measured by general human criteria, for example, career, marriage. By object criterion, fundamental risks arise from causes beyond the control of any individual or group and affect a large number of people, for example, earthquakes, war. Private risks, subjective in terms of causes and consequences. By cause criterion, natural risks arise from random events and natural phenomena independent of human activity. Anthropogenic risks result exclusively from human activity. By possible consequences, pure risks, possible losses are negative or zero. Speculative risks, possible losses can be positive, negative, or zero. By size, ordinary, small, medium, large, catastrophic. By main cause of occurrence, natural, ecological, political, transport, commercial, property, production, financial, liability. Insurance risks meet the following criteria. Losses must be measurable and insurance costs must be economically justified. To make a profit, the insurer needs data on the frequency and severity of losses caused by a particular hazard. If this information covers a long period and is based on a large number of cases, insurance companies can predict future losses fairly accurately. The insured hazard cannot result from intentional actions. Insurers do not pay for losses deliberately caused by the insured company or individual by their instructions or with their knowledge. The risk should not affect all insured at the same time. If the insurance company does not cover large geographic areas or populations, a single catastrophe could lead to very large insurance payouts. One type of risk should cover a significant number of similar cases. The more cases fall into this category, the more likely future experience will confirm the insurer's predictions. Potential financial losses must be significant for the policyholder. Insurance companies cannot handle claims for very small losses. Therefore, many policies include a clause specifying that only the part of the loss exceeding a certain amount stated in the policy will be paid. Any risk can be managed, which allows predicting its consequences and financial losses for compensation. The risk management mechanism, or risk management, is a set of diagnostic, organizational, preventive, and financial measures that are comprehensive, logical, and sequential, aimed at minimizing or preventing the negative consequences of a specific risk. The goal is to achieve the highest possible profit while maintaining an acceptable profit-risk ratio for the entrepreneur. Organization of risk management is a system of measures aimed at rationally combining all its elements into a single risk management process. It includes the following stages: defining the risk objective, the result to be achieved, and the goal of risk investments, maximizing profit. Collecting information about the environment necessary to make decisions regarding specific actions, determine the probability of an insured event, and assess its value. Assessing the probability, extent, and size of the risk. Choosing strategies and techniques for managing the risk, as well as ways to reduce the level of risk. Developing an action program to reduce the level of risk. Organizing and controlling the implementation of this program. Analyzing and evaluating the results of the selected risk decision. Methods of risk management include preventive methods, risk avoidance, avoiding activities associated with risk retention, keeping the risk with the investor or under their responsibility. Risk transfer, transferring responsibility for the risk to another party. Risk reduction, reducing the probability and size of potential losses. Repressive methods, aimed at suppressing natural disasters or sudden harmful events. Compensatory methods, self-insurance, insurance, bank loans. The stability of insurance companies is threatened not so much by taking responsibility for large risks, but by the accumulation of small risks within a limited insurance field, which relates to the concept of accumulation. Accumulation is a state of the insurance portfolio in which a large number of insured objects or several objects with significant insurance amounts can suffer from a single insured event, leading to large one-time insurance payouts by insurers. Causes of accumulation: concentration of insured objects in a limited area, presence of interdependent risks in the portfolio. The occurrence of one adverse event inevitably triggers several others. Reinsurance business processes where the cedent does not control a specific risk and may accumulate multiple parts of one large risk in the portfolio. Concentration of values in one or several objects. Risk management in insurance is carried out in 3 stages. Research stage involves detailed study of risks, collection and analysis of information about them, and risk analysis, comprehensive risk diagnostics using various methods, empirical, statistical, observation, etc. Preparatory stage involves comparing the characteristics and probabilities of risk obtained from analysis and assessment. At this stage, alternatives are identified in which the level of risk remains socially acceptable. Priorities are set, highlighting the problems and issues that require immediate attention. This allows ranking the available alternatives by acceptability: fully acceptable risk, partially acceptable risk, or completely unacceptable risk. Selection of specific measures aimed at eliminating or minimizing possible negative consequences of risk. This stage includes developing organizational and operational preventive procedures. For the insurer, it may involve preparing and issuing concrete recommendations to individuals who take or implement risky decisions regarding measures to fully or partially mitigate risks. Methods for risk assessment in insurance practice include the following: individual assessment method, applied only to risks that cannot be compared with an average type of risk. The insurer makes a discretionary evaluation based on professional experience and subjective judgment. The introduction of scientific and technological advances in various industries and agriculture, as well as the creation of large-scale objects with high value and unique technologies, increasingly makes this method necessary when concluding insurance contracts. An average values method involves dividing separate risk groups into subgroups, creating an analytical base for determining risk amounts based on specific risk characteristics. For example, the balance value of the insured object, total production capacity, type of technological cycle, etc. Percentage method, a set of discounts and surcharges applied to the existing analytical base, depending on possible positive or negative deviations from the average risk type. The discounts and surcharges used are expressed as a percentage of the average risk type.